The current price for NVIDIA stock sits at exactly $200 per share as of the market close yesterday, June 23, 2026, marking a significant intraday drop of 4.15% during that final session. Right now, it is Wednesday morning, June 24, 2026 at 10:51 a.m. East Coast time, and the major U.S. exchanges have just opened for live trading. Early morning ticks are showing immediate institutional pressure, and this major move lower has sent ripples through all major investing sites and the broader tech landscape. While most amateur investors looking at the Robinhood app are panicking over this recent plunge to the baseline flat mark of $200, the real institutional players are looking at something completely different. The big surprise that the broader market is failing to notice is not the drop itself, but the massive accumulation pattern happening in individual brokerage accounts and blocks handled by specialized desks at places like Fidelity Wealth Management. A lot of retail traders who rely on automated guidance like Schwab Intelligent Portfolios are seeing short-term stop losses triggered, but the underlying capital architecture tells us a story that contradicts the surface-level panic. The general expectation surrounding NVIDIA stock right now is built on a clear narrative. People think the initial phase of corporate hardware buying is finally hitting a hard ceiling. The common belief is that major tech entities cannot possibly keep spending tens of billions of dollars each quarter on infrastructure without seeing a massive immediate surge in consumer application revenue. Investors check their portfolios on the Interactive Brokers platform, see names like Apple stock and Tesla stock making their own volatile moves, and assume that the chip sector has reached its cyclical peak. This expectation creates a sense of dread that the premium valuation is about to completely fall apart. However, the reality of the situation is far more nuanced and structurally sound. The demand side has not softened. Instead, it has shifted from a chaotic land grab into a highly efficient, multi-tiered infrastructure build-out. Major data centers are not pausing their orders. They are shifting their capital toward next-generation configurations to reduce power consumption per compute unit. When you strip away the daily noise found on popular trading platforms, you realize that the market is punishing the company for a temporary supply chain transition rather than a structural decline in enterprise demand. To truly understand why the price hit this critical level during yesterday's session, we have to look closely at the recent stock movement. Over the past month, we have seen a steady drift down from the local highs near $236, culminating in the current testing of the psychological $200 floor. Trading volumes have been remarkably high, often exceeding 120 million shares per session. This indicates that this is not a low-volume drift, but a major battle between shorter-term momentum sellers and long-term asset managers. Much of this volume is being driven by macro factors. A recent hawkish shift in global regulatory frameworks, particularly out of Asian manufacturing hubs, has triggered a temporary risk-off sentiment across the entire semiconductor space. When macro pressures rise, institutional desks utilizing advanced Interactive Brokers trading setups often reduce their total exposure across beta-heavy assets uniformly. This mechanical selling creates an artificial drag that has nothing to do with specific corporate execution. Furthermore, look at how the options market is reacting. We are seeing a massive spike in implied volatility, which often signals that a local price floor is close to being established. Traders on retail investing platforms like SoFi Invest or using the Robinhood stock trading futures are buying short-term protection, while large-scale institutions are selling those expensive puts to generate premium, effectively signaling their willingness to buy the asset if it drops just a fraction lower. This dynamic shows a clear divide between public sentiment and private capital positioning. While the casual user scrolling through their Robinhood app sees a sea of red, institutional accounts at Fidelity Investments are treating this drop as a liquidity event to build out larger core positions for the quarters ahead. Let's pause for a quick moment to gather some live perspective from the community. Go ahead and comment below how many shares of NVIDIA stock you currently hold in your individual brokerage account, and whether you are using this recent dip to buy more, or if you are looking to diversify into other large-scale tech companies. To put this all into perspective, we need to take a step back and examine what this business actually does, and how its fundamental architecture operates. This company is not just a hardware manufacturer making silicon components. It operates as an integrated computing platform provider. Its core business model relies on designing high-throughput graphics processing units that excel at parallel processing tasks. These systems are paired with proprietary software layers that have been embedded in deep tech developer workflows for over a decade. By locking in the software layer, the firm has built an incredibly wide moat that makes it incredibly difficult for cloud providers to swap out their hardware for cheaper internal alternatives. Looking back at older reports from previous fiscal periods, the company consistently achieved gross margins above 70%, a figure that is almost unheard of for companies that rely on physical manufacturing. Past performance shows a track record of identifying structural shifts in enterprise computing years before they manifest in public markets, allowing them to capture almost the entire market share of early deployment cycles. This brings us back to the core conflict between current expectations and hard reality. The market narrative states that because the hyperscale cloud providers are facing intense scrutiny over their capital expenditures, the demand for high-end silicon must inevitably drop. The reality, however, shows that corporate data center budgets are actually being reallocated away from traditional central processing units directly into parallel computing clusters. This is not an expansion of total spending in some cases, but a massive internal cannibalization of classic IT budgets. When you analyze the numbers through a premium individual brokerage platform or run the metrics through detailed investing sites, the earnings power remains remarkably clear.
The trailing price-to-earnings ratio has actually compressed to a highly reasonable multiple compared to historical growth rates, making the risk-reward profile at the current price level far more attractive than it was when the stock was trading near its record highs. Looking forward, there are several key catalysts and risks that will dictate whether the stock can successfully defend this $200 level and build a base for its next upward move. The primary near-term catalyst is the upcoming production ramp of their next-generation chip architecture. Any clarity regarding supply chain yields and shipping schedules will immediately alter the consensus estimates on advanced trading platform databases. If the firm can prove that manufacturing bottlenecks are clearing faster than expected, the current short positions will face a massive squeeze. On the flip side, the risks are heavily tied to global logistics and macroeconomic policy. If inflation metrics remain stubborn and central banks hint at keeping interest rates elevated through the end of the year, growth multiples across the entire tech sector will face continued downward pressure. There is also the reality of rising competition from custom internal chips designed by the cloud giants themselves, though these internal options have yet to match the broad developer ecosystem provided by the incumbent platform. When you look at the total landscape of online investing today, the options for navigating this volatility are vast. Whether an investor chooses active management through Fidelity Wealth Management, utilizes self-investing tools on modern platforms, or relies on automated algorithms like a SoFi robo-advisor, the ultimate success of the position comes down to understanding the structural reality of the company versus the short-term emotional swings of the public market. The tension between what the average trader expects to happen based on daily headlines and what the balance sheet actually dictates is where the real value is found. Those who panic sell during macro-driven liquidations often end up buying back into the same asset at higher prices once the structural strength becomes obvious to the masses again. In summary, the narrative surrounding this technology heavyweight is caught in a classic push and pull dynamic. The superficial expectation is that the peak has come and gone, driven by a sharp intraday drop to the $200 mark and a wave of negative global sector momentum. The deeper reality reveals an enterprise that maintains an iron grip on corporate computing infrastructure, backed by exceptional historic margins and a software ecosystem that prevents easy customer defection. The current price action is a reflection of macroeconomic anxiety and supply chain transitions rather than a failure of core corporate execution. For anyone tracking their positions across high-end individual accounts or checking their mobile trading apps, keeping this clear distinction between short-term market emotion and long-term structural reality is the only way to maintain true clarity in a volatile market landscape.